Dividend stocks versus index funds, which builds more wealth? Here's something worth thinking about before you make your next investment move. Most people who get into dividend investing do it because it sounds like the smartest thing you can do. You own stocks. Those stocks pay you money. You use that money to buy more stocks. Repeat for 30 years. It's clean. It's logical. It feels like you've figured something out. And index fund investors? They just buy a fund. No strategy. No income. No story to tell. Just slow, boring accumulation. But when you actually sit down and run the numbers, not the headline numbers, the real ones, something uncomfortable shows up. And it's not what either side usually talks about. Let's get into it. The appeal is real. I want to start by being honest about why dividend investing is genuinely attractive. When a stock pays you a dividend, you feel it. $200 hits your account in March. Another $200 in June. It's not theoretical. It's not a percentage on a screen. It's actual money, and that feeling matters more than most financial writers admit. There's also a logic to it that holds up on the surface. Companies that have paid and grown their dividends for 25 or 30 consecutive years, your Coca-Colas, your Johnson & Johnsons, these aren't accidents. They're financially disciplined businesses with consistent cash flow. Investing in them feels responsible. And in certain situations, dividend investing genuinely is the right call. I'll come back to that. But here's where most people stop asking questions. They assume that because dividends feel like income, they are income. And that assumption is where the gap starts opening up. What a dividend actually is. There's a concept in finance called dividend irrelevance, and it's been understood since the 1960s. It's not controversial. It's just not talked about in places where people learn about investing. When a company pays a dividend, its stock price falls by roughly that same amount on the day the dividend is paid out. If a stock is worth $50 and pays a $1 dividend, you now have $49 in stock and $1 in cash. Your total position hasn't changed. You moved money from one pocket to the other. That's not a criticism. That's just mechanics. The real question is what happens next, specifically, what the tax treatment does to your long-term position. The tax problem nobody mentions up front. Let's say you're in a regular taxable brokerage account, not a Roth IRA, not a 401k, just a standard investment account. This is where most people hold their dividend portfolios, because they want access to the income. Every dividend you receive is taxable in the year you get it. Even if you immediately reinvest it. The IRS doesn't care that you didn't spend it. You received it, so you owe tax on it. Qualified dividends, from most U.S. stocks held long enough, get taxed at long-term capital gains rates. That's 0%, 15%, or 20% depending on your income. Not terrible. But non-qualified dividends, which include most REITs and a lot of high-yield ETFs, get taxed as ordinary income. Same rate as your salary. If you're in the 22% or 24% bracket, that's what you're paying on every single distribution. Now compare that to a broad index fund like VTI or VOO. These funds generate minimal taxable distributions because they don't trade frequently. They just hold and hold and hold. The tax event for an index fund investor in a taxable account is largely optional. It happens when they decide to sell, not when the fund decides to pay out. That difference, taxed annually whether you want to be or not versus taxed only when you choose, compounds significantly over time. We're not talking about a rounding error. Across a 25 or 30-year window, that tax drag can represent hundreds of thousands of dollars in foregone compounding. The return gap. Here's the other piece. Dividend-focused portfolios tend to concentrate heavily in sectors like utilities, consumer staples, financials, and energy. These are solid, mature businesses. But they're not the sectors that have driven the majority of stock market returns over the last 2 decades. Technology companies, which tend to reinvest profits rather than pay dividends, have been the biggest return drivers in modern market history. When you build a portfolio specifically around dividend yield, you often systematically underweight the part of the market that's compounding the fastest. The S&P 500 has historically returned around 10% annualized. Dividend-focused strategies have historically returned closer to 9%. That 1% gap sounds forgivable until you let it run for 30 years on a significant portfolio. Then it becomes a number that's hard to look at. Add the tax drag on top of that, and the real-world performance gap between a dividend portfolio and a simple index fund, in a taxable account, over a long time horizon, tends to be meaningful. Not catastrophic, but meaningful in a way that permanently changes retirement math. Where dividend investing does make sense. I said I'd come back to this, so here it is. Inside a Roth IRA, nearly everything I just said disappears. Dividends grow tax-free. You never owe tax on distributions inside a Roth. If you love dividend stocks, this is where they belong. The behavioral benefits, the feeling of income, the motivation to stay invested, the sense that your portfolio is actively rewarding you, remain intact. The tax disadvantage doesn't. For someone who is already retired, or within a few years of retirement, the calculus also shifts. If you genuinely don't want to make regular sell decisions in your 70s and 80s, having a portfolio that generates income automatically has real value. Not a mathematical advantage necessarily, but a behavioral and logistical one. And those matter. And dividend growth stocks specifically, companies that have raised their dividend for decades consecutively, have historically delivered decent risk-adjusted returns. Not because of the dividend itself, but because those companies tend to be financially sound. As a partial allocation inside a broader portfolio, they're a reasonable choice. The issue isn't dividend stocks. The issue is building your entire wealth accumulation strategy around them in a taxable account, during your working years, when time is your biggest asset and tax efficiency matters most. The behavioral thing that cuts both ways. Here's something that doesn't get enough credit. The dividend investor who stays fully invested through a 35% market crash because dividends kept arriving, that person outperforms the index investor who panic sold in month 2 of the drawdown. Every time. Mathematically superior strategy means nothing if you abandon it when things get ugly. Dividend checks are psychologically stabilizing in a way that a declining balance is not. That's not irrational. That's human. But the reverse is also true. The dividend investor who mistakes cash flow for performance, who feels like the strategy is working simply because payments keep arriving, even when total returns are lagging, that person is being misled by the same feeling that kept them calm during the crash. Feelings are useful data. They're just not reliable performance metrics. What the math actually suggests. If you're in a taxable brokerage account, building wealth over 20 or 30 years, the math consistently favors low-cost index funds. Lower fees, lower annual tax drag, broader diversification, and more control over when you realize gains, including the ability to potentially pay 0% on long-term capital gains in retirement if you manage withdrawals carefully. That last point is underrated. An index investor in retirement can often control their taxable income in a way a dividend investor cannot. Dividends arrive whether you want the income that year or not. Capital gains from selling shares happen when you decide they happen. The combination of higher accumulation and more tax control in retirement is a significant long-term advantage. The honest takeaway. Dividend investing isn't a scam. It's not stupid. It has a real psychological pull, it works well in the right accounts, and it suits certain investors at certain stages of life. But for most people, in a taxable account, in their 30s or 40s, with a long time horizon, the gap between dividend stocks and low-cost index funds is not a tie. The index fund wins on fees, wins on tax efficiency, wins on diversification, and historically wins on returns. The reason more people don't choose it isn't because they've done the math and found a flaw. It's because a number quietly going up doesn't feel like enough. And dividend checks do. Feeling like you're winning and actually winning are two different things. Over 30 years, the difference between them can be significant enough to change what retirement looks like. That's worth knowing before you build your strategy around one or the other.